Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day today. And in today's markets, guys, well, the SPY and the QQQ bulls push a little bit higher and the rally continues on. And this time it did it on much better breadth. Several sectors that were left behind in the most recent few days, such as healthcare and consumer defensives, came roaring back and really helped the bulls out when they needed it the most. And QQQ was actually one of the weakest performers after lifting the market on its own for the past 2 weeks, taking a bit more of a breather today, and the rest of the market being there in rotation fashion to kind of pick up the slack. Now, you might be asking yourself continuously, why do we remain in an uptrending rally and perpetually going up and to the right? Well, as we discussed earlier on this week, it is a lack of bearish headlines, in which right now we're in an environment where the uncertainty factor is much less than it was just a month ago, as we continuously get new policy updates every single day and new trade deal updates every single day as well. So those are the main key contributors. And as long as we don't get any negative news headlines, you're not going to get that spark that people have been looking for to pretty much put us underway into big daily consolidation after a few beautiful weeks of rally underway. And today was no different, guys. In terms of the news headlines, well, we got a couple early this morning, which showed that, as a matter of fact, there are still some deflationary pressures in the economy. We got retail sales early this morning that showed only a 0.1% increase month over month, potentially as people scale back their purchases because of the potential impacts of tariffs and potentially the recession narrative that may be on the horizon, but that definitely doesn't contribute to bringing up inflation right away. Will inflation come as a result of higher prices in the future? Well, that is of course on the table and will remain to be seen. What do we also have on the producer side? Well, we got producer inflation numbers, and that built upon the very favorable consumer inflation headlines that we got earlier this week, in which we saw drops in the CPI month over month. Well, producer inflation was no different. We got a nice 2.4% read year over year for producers. That was below the expectation of 2.5, and month over month actually came down in a wild fashion, 0.5% to the downside. So we have a disinflation narrative on the producer side. Why? Well, if you look into the gist of the headlines and the data this morning, it showed that for actually the producers were willing to take the hit in the margins. They are absorbing the potential current price increases of tariffs rather than putting it onto the consumers' back. And when asked why, well, they justified it by they do not want to reduce demand towards themselves. So they are currently taking that in the margins. That is, of course, bad for them, bad for business, possibly could lead to some layoffs down the line, but it definitely does not lead to inflation right now. And when the market saw that, well, the markets actually celebrated those two current things. And also we did see yields start to plummet as more and more disinflationary reads from producers and inflations overall can possibly lead to a scenario where the Federal Reserve, even though they may not want to, can possibly cut earlier than anticipated. Those rate cuts are still going to be the hotly watched topics over the next few months. So in today's video, guys, we got a few things to take a look at together. Number one, we're going to be going over two corporate earnings that I have prepared for you guys, and those are going to be Walmart and AliBaba. Special shout out to everybody else that was reporting today, but just to save some time, I figured I should do the two biggest ones of the day, and in my opinion, it was definitely those two. On after that, we're going to take a look at our technical analysis rundown of our major market indexes, check on that rotation, and thereafter check on our big tech names as well. See how they're doing after some consolidation. Is it time to reload on some swing trades for some of the big tech names? We'll do a full rundown of this list and I'll give you my ideas on that. And lastly, as we've been doing recently, we'll take a look at your day's biggest winners and losers. To the downside, Fiserv, UNH, and a few more. And to the upside, we actually had a number of value and defensives names performing quite well, one of which I had started a swing trade on in the last few days and is moving properly in the right direction. So that is the format for today's video. As always, if you want to skip to a certain portion, feel free to click down below in the description to the timestamps of where you want to go. So that being said, let's jump right into it, shall we? The SPY up 0.49%, the Qs up 0.11%, and the rotation overall was much healthier than yesterday. Yesterday, we were noting that although we are right now in a relatively greedy environment, we are looking for breadth to be waning. And in the last few days, we were seeing a dwindling of that market breadth, and we were determining whether or not that was going to lead to a daily consolidation phase for the markets, or whether or not the bulls could come back, rotate into the sectors left behind while tech consolidates. And happy to say it was actually the latter. Big tech consolidating once again today, but the whole rest of the market was definitely there to pick up the slack, anywhere from financials to healthcare finally, and the bottom half of the market responding very well to those lower than expected inflationary pressures across producers, which saw yields came down, which definitely helped out some sectors like real estate and utilities. Moving on to the one-day relative performance here, you can see that even better. Utilities, defenses, real estate, healthcare, basically everything that had been left behind a bit in the last few days of trade. And what went to the downside? Well, consumer cyclical and technology, which has been the hottest performers of the last week. You can see that right here. 1 week relative, tech and consumer cyclical were the best performers, and now today they were relegated to the bottom. But overall, on the 1 week relative, it does show that the market is definitely more broad than not. So before we get into more technical analysis and go through the indexes, let us dive into the earnings right away. And we're going to start off with a very big one. And of course, that's going to be Walmart. So Walmart coming in this morning, guys, and Walmart at one point was down almost 5% after their earnings. And that was because they missed on revenue for the first time in 5 years. Since 2020, Walmart had a very microscopic miss on revenue, but a miss is a miss. They did manage to beat on EPS by 6% though, but a big focus of today's earnings was not so much on the numbers, but in terms of the guidance that they gave all the way back here, last quarterly earnings. I'll remind you, after the Walmart sell-off, last quarterly earnings, that is what really kicked off the sell-offs on the SPY and the QQQ, as they warned about the impacts of tariffs, possible price increases from consumers, and also gave somewhat lackluster guidance for the year, reducing their guidance as a matter of fact. Now, 1 quarter later, we were determining, are the impacts of the tariffs here yet? And how does the company currently feel about the economic landscape? Because this company definitely serves a lot of customers and they have a lot of data. Let's jump right into it, shall we? So into Walmart, the CFO saying that the price hikes from tariffs could start later this month as the retailer beats on earnings. Let's move into it, shall we? So they actually stuck by their full year forecast, reiterating their guidance, which was very good, which calls for sales growth from 3 to 4% and adjusted earnings of $250 to $260. That was in line with their guidance last quarter. It posted its first profitable quarter for its e-commerce business, both in the US and globally. Very good for the company. We've been watching the e-commerce division very closely. The CFO saying that the tariffs, however, were still too high, even with the most recent announced tariff pauses. Here's what he said. We are wired for everyday low prices, but the magnitude of these increases is more than any retailer can absorb, even them. It's more than any supplier can absorb. And I'm so concerned that the consumer is going to start seeing higher prices. You'll begin to see that, likely towards the tail end of this month, and then certainly much more in June. So some commentary there on the tariffs. Same-store sales were a bright point for the company, 4.5%. We don't see any notable weakness in Walmart same-store sales just yet. But once again, could that be possibly had on the horizon? Maybe, but we're not seeing it right now. On further, e-commerce sales increased 21% in the US. That was the 12th straight quarter of double-digit gains for that portion of the business. Global e-commerce sales, 22% year over year. Another stellar quarter for Walmart e-commerce. You can see that they've been growing this brand in a very healthy fashion, at least over the last 2.5 years. Moving on further, Rainey, the CFO, told CNBC that Walmart has not seen a noticeable shift in consumer behavior from previous quarters. They're discerning, they're mindful, speaking about consumers. They may be a little concerned about possible looming price increases, but their behaviors largely have not changed. They're still looking for value. Moving on further, he said the results in February fell below the company's expectations. March results came in closer to what Walmart expected, and then April was a lot stronger. So far, for May, he feels a lot more like April with sales patterns. So not too bad, even though consumers may be saying that they're feeling the pinch of possible tariffs, they're definitely not changing their spending patterns. Who did we hear that for more recently? We heard that from Visa, MasterCard, and American Express, guys, to where the consumer sentiment was bad, but it's not actually showing up in the consumption patterns just yet. The average ticket increased 2.8% year over year, showing that Walmart still does have some pricing power. But speaking about that pricing power, are they going to absorb the impacts of the tariffs or pass it on to consumers? Well, we have some insights down here. About a third of what Walmart sells in the US comes from other parts of the world. The CEO said on the company's earnings call that tariffs on China in particular create the greatest cost pressure. He said imports from the country account for high volume in categories such as toys and electronics. Now, who's going to absorb the tariffs? Well, he said Walmart plans to play offense by keeping its price gaps below competitors. He said the company will absorb some of the higher prices from tariffs and expects that the suppliers will too. Sales for the US advertising business, Walmart Connect, increased 31% year over year in the first quarter, and that is a decent little profit driver for the company, which kind of offsets the fact that they have to absorb some of the tariffs in their retail business overall. So not a bad quarter for Walmart, but you can definitely see some hesitation from management in terms of future guidance. but all is well right now for the company. Into a few earnings slides, if you will, so you can see total revenue graph right here, very healthy year-over-year change of 4%. Gross profit rate will be heavily under scrutiny in the next few quarters as we measure the impacts of cost of goods sold. Will Walmart absorb them, and will that hit their profits, and how much? Well, we'll have to take a look at that as the year moves on, but as of right now, the gross profit rate still at a very historical average of about 24%. Operating expenses as a percentage of net sales has been fairly smooth at about 20.8%. That's historically average for Walmart, at least it has been in the past few years, and operating income as well, up a decent 3% year over year, with adjusted being roughly the same too. EPS, no change there, not really seeing it hit the bottom line to the company, and operating free cash flow was a little bit better than we had in Q1. I'll remind you, this business kind of starts off slow as the year starts and then moves on, and their best quarter, similar to Amazon type of thing, is usually always in Q4. You can see free cash flow was a little bit light here in the first quarter, and that's usually always the case for Walmart. They have a slim free cash flow in the beginning of the year, as that is when they usually set aside all their money and start investing in terms of new store openings and also store renovations as well. In terms of returns to shareholder, you can see that Walmart did a great job of buying back their own stock during the quarter. $4.6 billion worth of stock was repurchased during the quarter, which really dwarfs everything that they had been doing for the core 4 quarters prior to that. And they do have a remaining share authorization of around $7.5 billion. So after those earnings, is Walmart a buy? I'm sure that's the burning question that a lot of you may have. Let's take a look at the valuation down here, shall we? At $95, they're trading at a forward price to earnings of 36.5. They have a forward peg of 3.32. But I'll remind you, when a company is not growing EPS at a very high clip, and when a company is a more mature company, PEG ratio is not usually the best, right? What you would tend to look at is price to sales and free cash flow yield. At about a 1.10, that is not too bad for Walmart. That's in around their historical norms. And a free cash flow yield of 2.4% is slightly underwhelming, but I wouldn't say it is dirt low, you know what I mean? It's not bad, objectively speaking. So Walmart's a very solid company. It needs no introduction, of course. Very solid business model and fairly resilient. As keyword is resilient, not recession proof, but is resilient throughout the phases of a recession, as consumers from all income demographics tend to pivot down to Walmart more so than just avoid them overall. EPS for the next few years is steady to increase, and revenue for the next few years is steadily increasing as well. So this is a fantastic company. This one and Costco are probably my two, big favorite retailers in the market right now. It's really a question of which one you prefer. I would not mind holding Walmart in my portfolio. Is it a buy right here? Well, it's not the best buy in the world, but if you're looking for something very stable and very defensive across all different markets, well, it may just be the company for you. However, since it is trading relatively high and somewhat a little bit rich right now in the face of uncertainty, maybe you do something like a quarter position or 30% position, and then possibly leave some room to DCA as the year moves on if Walmart does make its way back into the $80 mark, which I think does present some better value. That's everything for Walmart earnings. Hopefully you guys enjoyed that. Now let's move on to earnings number 2, which is going to be another nice one, AliBaba. So shifting our focus to Baba, you will see that they were down 7.5% on the day because the market just did not like their earnings. And quite frankly, they did have a double miss. They missed on EPS, but they did also miss on revenue by about 1.33%. And now we just covered a big box retailer in the United States, such as Walmart. Although Alibaba is not a big box retailer, it does provide some insights, this time into the Chinese consumer. So if American consumers are slightly feeling the pinch of the current policy environment, are Chinese consumers feeling the same? That is what we are seeking to understand in these Alibaba earnings. And the answer is yes. Let's take a look at it, shall we? So Alibaba shares dropped more than 7% on a big profit miss. Let's take a look, shall we? Revenue was nevertheless up 7% year over year, which is decent. The net income was also still 280% higher year over year. So the net profit miss was a reality. However, it is still up massively on a year over year as it's coming off a low base. Baba said it saw some losses as a result of the disposal of some of its subsidiaries, which was offset by an increase in income from operations and changes to valuations of its equity investments. So doing some fancy accounting there, rearranging the profit curve, and so far they didn't make it out of it too poorly. Analysts were hoping the company's investments in AI and its core e-commerce business would help it hit or exceed the expectations. Unfortunately, that was not the case. Baba is grappling with macroeconomic volatility that has affected consumer sentiment in China as well, of course, because of the ongoing trade war. Now, the e-commerce business saw revenue rise 9%, consumer management revenue, which is basically selling marketing and other services to merchants on its platform, jumped 12% year over year. So the numbers aren't bad, but definitely not as good as some of the numbers that Baba was posting at this same time last year when we saw double-digit growth rates across the board. On the earnings call on Thursday, Baba management said that the company would be investing aggressively in its so-called instant commerce model, a new model for Alibaba. This is a feature introduced on Taobao this month that provides deliveries of certain products in China within an hour. Must be nice. That would be fun, right? Amazon deliveries in an hour, underscoring Alibaba's bid to continue to differentiate itself from its rivals. Even with these changes, Baba is facing an intense price war in China with rivals including Pinduoduo and JD.com. Every company trying its best to really undercut each other and get that consumer, right? Trying to keep demand high, which is kind of what we just saw from Walmart as well. They said that they would maintain a low price, aggressive, offensive strategy to retain that demand and take that demand away from their competitors. And seems as though in China, they're playing the same price war games. Now, Alibaba said cloud revenue totaled 30 billion won in the quarter. That was an increase of 18%. This has been a very big growth and revenue driver for the company, but is also a very profitable segment of the business for them. That revenue growth was driven by faster public cloud revenue and by increasing adoption of AI-related products. The CEO, Eddie Wu, said in an earnings release that AI-related product revenue achieved triple-digit growth for the 7th consecutive quarter. However, he did not specify a specific monetary amount for the AI-related revenue. Speaking about the various different revenue segments of Alibaba, let's have a look at how they're progressing over time. Here's a chart of the Taobao and Tmall group, which is their e-commerce segment in the orange. And down below, you have Alibaba International Digital Commerce revenue. So one is within China, that's the bulk of the company's revenue, and then international is down below. You can see that for the most part, on average, Baba has been growing both segments quarter over quarter ever since they had a bit of a cyclical low down here in 2022. The international segment still does remain fairly good. Moving on to other aspects of the business, I've done a breakdown here of their different lines of business across the past 2 years. The big blue segment right there is Taobao and Tmall China commerce revenue within China. So pretty much the orange line right there, that is trailing 12 months revenue. Now the orange line down here is the China commerce wholesale revenue, a small portion of revenue for the business, but still it is $3.3 billion. On the purple, we have international digital commerce retail, the blue segment from down here. This is just broken down so you guys can see year over year, the segment is growing nicely. Now the green segment, the newest portion of their business over the last 3-4 years, is cloud. And we can see that cloud is expanding well at a double-digit clip. And lastly, we have digital media and entertainment, the little red segment, all segments of the business pushing up and to the right, which is exactly what you want to see. Now, we know the revenues are pushing higher, but what about their expenses? Well, if you take a look at the earnings slides right here, we can see that in terms of the cost of revenue and operating expenses, well, the cost of goods sold is actually moving into a lower and lower portion of the total percentage of revenue, which is exactly what you want to see. A company growing revenues, but expenses growing less quickly. That is what we call operating leverage. Product development expenses are also representing a smaller proportion of revenue over time. And overall, especially when you measure on a year-to-year basis. As a matter of fact, this one is slightly up, but this has been coming down a lot in the last year since I've been talking to you guys about this company when we do their earnings slides. Now, sales and marketing as well. Sales and marketing actually had an uptick here from 2024 to 2025. So that's not moving in the right direction, but still, if they're trying to stay at the cutting edge in terms of being on top of their competitors and offering brand new services, such as the one we just described here right there, in terms of the instant commerce model, where they're going to have to get that out into the public eye. So that is fine right there. And then general and administrative expenses also with a tiny little uptick overall. So they're getting a good, nice drop in cost of goods sold, but they are spending on a bit more on operating expenses overall. So operating leverage maintaining roughly flat for them in several other different segments of operating expenses, but I would not say it's problematic as this one has come down significantly over the last 2-3 years as cost savings has really been front and center for Alibaba as they keep pushing forward. Now, is this company a buy right now at 123 after they've rallied significantly since the low 80 marks? I was telling you guys, Alibaba was probably the buy of the century down here. A few people actually got this one. right? But up here, now that we're up here, right, at 125, is it a decent buy? Well, let's have a look at the 125 level. They're currently trading at a forward price to earnings of only 12.5. Now, this is no stranger to Alibaba. They've been trading cheap for the past, what, 3-4 years at this point, and a lot of their Chinese sector peers as well, such as JD.com, Pinduoduo, or even, a company like Baidu. All the Chinese companies are trading at very cheap multiples because there's a lot of uncertainty surrounding China, not only now with the trade war, but even prior to the fact that they were still in a bit of a cyclical recession where the economy just has not been strong. That being said, they're expanding revenue and EPS at very nice clips. That gives them a PEG ratio of 0.93, which is very manageable in my opinion, and a free cash flow yield of only 3.2%. Now, they spent a bunch of money on property, plant, and equipment, which is why the free cash flow yield is still very small right now. You might remember from some videos maybe last year, the free cash flow yield was 10%. Well, they're taking all their free cash flow right now and investing it in both the cloud division, which is growing, and also just investing in more warehouses for their e-commerce brand and pushing internationally as well. So the free cash yield has dropped, but what they have not done is spend the cash on hand. They still have $50 billion of cash on hand. And during 2024, they were able to repurchase $12 billion worth of shares, which was 5% of the float. So I do still think that Alibaba does have some upside from here, but it of course is a bit of a risk reversal trade, right? There's a lot of risk surrounding the China trade right now. If you're the type of person that wants to embark on those risks, I would say that it is a very decent deal, not as good as of a deal as we had back here when the stock was under $100. I wouldn't mind positioning here overall. I'm personally in KWeb, the ETF, so I remove stock-specific risk and I just go with the China trade overall, but accumulating a position on Baba here in the 120s, and if we fall back down into somehow the 100 range or below, an accumulation of a position here to be maintained for the next few years, if your thesis is that the Chinese economy will come back and global trade will resume as well, may not be the worst bet to be had in the market, but you might need to be a little bit patient for that. That is everything that I had for your earnings today, guys. Hopefully you enjoyed those. Now, let's dive right into our analysis of the indexes. And of course, we're going to start off with the SPY. So we're going to want to run through these quickly, guys, because I've been talking about the catalysts for a pullback all week, and it all starts essentially with a loss of your short-term time frames. No loss of the 4-hour trend, no loss of the 1-hour uptrend either, and you are just going to continue pushing higher. That being said, the SPY is looking pretty good right now. Daily uptrend is very clear. Next target area will be resistance up here, 600 up to 610 on the SPY respectively. Below us, we are establishing a nice shelf of support by clearing the resistance range, and that is once again 585 to 576. So don't get ahead of yourselves, right? I know everybody wants to short the market, but you do not have an entry catalyst for shorting the market. For that, you would need to see a loss of the 4-hour trend and start setting some lower lows on the daily timeframes. Only then will you know the daily pullback is underway, and then you know that anything above 555 is just looking for a higher low, possibly for some further trend continuation. First stop will be here, second stop will be probably in the EMAs, and if we unravel into the daily downtrend, you guys know it best, we're going for some weekly higher lows, anything above 508, looking for a weekly higher low. Shout out to this area right there, 565 to 550. This little pocket, if ever we pull down there, could be a very nice area for some heavier swing trade longs at better risk to reward profiles with a crossing of the weekly MACD overall. Onto the QQQs right now, same concept. The Qs were green, but also pulling up into resistance 525 up to 535 as the big tech bulls appear to be a little bit tired. They've been pulling back for now 2 days in a row. That being said, no sacrifice of the daily uptrends right now. We are still looking for a possible rollover, and that could take us down into support area number 1, 510 down to 500. This whole area that was support during the December period, that will be support again as the 12 EMA curls up. In the event you pull back, you're looking for higher low, anything above 477, higher low, possibly for another attempt at the highs up there. And if ever you lose the daily uptrend, you guys know it best. What are we looking for? Weekly higher lows, anything above 426, looking for a weekly higher low. Special shout out to this very large area in which we just lifted off from 487 down to 469. That'll be a very, very juicy area for a bit of a retest if we get some negative headlines, especially in light of the crossing of the weekly MACD. But the bulls remain in full short-term control of this market. Just trade the trend, guys, right? If you do not see the entry criteria for a short, you are doing the same thing as trying to catch a falling knife down here, but you're doing it in reverse. You're trying to pick a top when the bulls control the dailies and the weeklies. onto the XLF right now. XLF also holding the bull flag at the top end of the push, looking very good. Still getting stopped out, however, though. 51.50 down to 50.75 is the area of resistance. We will see, can we get the good old breakout, retest, and run? That would be one trade entry, or maybe we just have to consolidate a little bit lower. Now, if we do consolidate lower, anything above 49, looking for a daily higher low for possible a second attempt at breaking through this resistance. And if ever you lose the sequence of higher highs and higher lows into the daily downtrend, you guys know it best. The weekly higher lows are on deck. Anything above 45.22, looking for a weekly higher low for possible further trend continuation. If you see some weekly consolidation, these guys down here, 48 down to 46.5, that is a very juicy area, guys, for the good old pullback and possibly reload of some heavier swing trade longs, as the risk to reward up here is not the best, but if we come down there, it gets quite juicy quite quickly. Now, talking about healthcare actually starting off red, and then now today ending in the green. 1.31, it was one of the best sectors in the market today. Healthcare still remains somewhat oversold, as the RSI on the daily is very weak, and the weekly RSI is down here at 33. Now, not technically in oversold conditions, but very low, that being said. All up in consideration, guys, the bulls have a lot of work to do, yeah? Daily downtrend, you need to get it back. Give me a very nice bounce, give me a daily trend change, then we can officially say the weekly lows are in, and you can seek to possibly recapture some of this weekly action. We are right now still trading below the 200 weekly EMA, which rarely gets tested for this sector, and also below the 50 monthly EMA, which gets tested equally as rare. Now, moving on forward, this was one that was under the scope yesterday for some leap call positions, and I probably will be opening some leap call positions on XLV, probably for the January 2027, and possibly around the 130 strike for about $1,500. I showed it to you guys yesterday. Rather than picking different companies in healthcare, because a lot of them have been weak, right? There's a lot of great companies that are really, really weak right now. Rather than choosing them individually, I might just go with the sector overall. Moving on to SMH right now, down about 0.35%. Not the worst day for SMH, but it was a red day. Into resistance still, 260 down to 246. That is the area that we're struggling with right now. Remains to be seen. Can we still push through it? If ever we get rejected from here and we continue on to, losing the hourly time frame first and cascade into the loss of the 4-hour time frame, then you will know daily consolidation is underway and you should be expecting a higher low, anything above 212, looking for a daily higher low for further trend continuation and a second attempt at the overhead resistance range. Beautiful area of confluence down here, all the EMAs and the support area 232 down to 213. I'd be a very big fan of playing a back test of that level, especially with a crossing of the weekly MACD. Give me a little bit of a weekly backtest, and I will probably position for more swing trade longs into that area as the bulls control the dailies right now, and especially they control these weeklies. So any extended pullback, in my opinion, would definitely be for a good old breakout, retest, and possibly look to recapture the higher levels. On to IWM Russell right now. The Russell up about 0.65% today. You can see what the bulls are trying to do. They're trying to set up the daily higher lows. The Russell has consolidated more than the other indexes recently, and the bulls are still in a very, clear uptrend right now. Remains to be seen if they will push further. If they don't, right, we're into resistance right now, 217 to 208, with the 200 EMA right above us right now. It's a fairly big level for the Russell, guys, all things considered. Big congestion, big resistance, and prior support from 2021. It is a very big level. That being said, still looking for a daily higher low, anything above 195, looking for that higher low, possibly for another attempt at the upside. I would only take one of two trades right here, either the breakout, retest of this range, or give me a back test down here into the 200, roughly the 200 area with the EMAs. Very easy, right? Back test down here, stop goes below the low, and then you're targeting the higher levels of breakouts overall. Right now, going long from here into resistance is not the best value in terms of risk to reward, so keep that in mind. However, the bulls do maintain a very casual weekly uptrend right now, not looking too bad. And same thing, all of these weekly MACD charts let us know that even though we may find some temporary consolidation, maybe we're going into a few weeks or maybe even a month of possible upside recapture for the bulls. We might be looking to push a bit higher. And lastly, the Dow Jones. Dow Jones recovering largely thanks to healthcare today. We were continuously seeking the daily higher lows again on this index too, but now trapped in resistance, 42.5 down to roughly 41.9. All in all, same thing as the Russell, right? You're into resistance. So the trade on the Dow Jones would be a breakout, retest, then I have a clearly defined level, right? The breakout, the retest, stop goes below this guy right there. However, if we come back down, that's also another swing trade opportunity, as if we pull back into here with the EMAs into 41,300, very easy entry attempt for a higher low, stops go below this guy, and then you're targeting the expansion into the previous highs overall. That being said, the bulls are in control of the weekly still, gorgeous weekly uptrend, so any consolidation will be looking for a higher low on the weekly, anything above 37.9 for that higher low. We'll go through the minor sectors tomorrow as we do every single Friday. The VIX, we're not going to spend too much more time on this until it shows that it wants to do something. Again, down below today, moving towards the lower end of the range. Any negative macro data or negative headlines will contribute to that spark that might reignite the volatility and may send the indexes into consolidation, but no signs of that just yet. The dollar still being on the watch for this one, still in a nice daily uptrend, looking to recapture this big area of resistance. Can they do it? I don't know, but it was a nice 618 bounce. So now the bulls may be looking to slowly recapture the weekly uptrend. We'll see if they can get it, right? The other scenario is the downfall, but if we don't have any crazy negative headlines, maybe the dollar will be making its way back, especially with all the late arrivals of participants into equities. People largely feeling left behind right now. Institutions, both domestic and abroad, must be feeling the same. So we'll watch the movement on the dollar onto the 10 and 20-year yields. Well, off the back of those two reports this morning that showed that we were actually in a disinflation environment right now, it led the markets to believe that maybe the rate cuts might be coming sooner than later. 4.55 has been the area of contest where the bulls, or rather the bears, on yields tend to play a lot of defense right there. And funny enough, every time we come into here, something happens that pushes them back down. Today, it was the bullish reports on the inflation front. So the 10-year coming down, but still relatively high. The 20-year coming down, but still relatively high, which leads into my thesis for bonds. I've always been a very big fan of bonds down here, but you just need to take your time with them. It's fine to accumulate a position, but don't think bonds are going to do this. It's not Palantir, right? It's a great area to accumulate bonds if your thesis is for rate reduction and the reductions of the 10 and 20 over time. But notice how I say over time, and trust me, that time horizon is probably like 9 to 18 months, so keep that in mind. Moving on to gold right now. Gold was actually not performing too poorly over the course of the day today. Matter of fact, they had a nice little bounce. They started off red and recovered nicely, a 2% day in the green for the Thursday close. That being said, the bears are in short-term control right now. Big engulfing move, possibly looking for a lower high, right? Depending on the size of the bounce, if the bounce is a nice 618, 782 bounce right there, then it gives them the chance to maybe reset into an uptrend. We'll keep our eyes planted, but one thing's for sure, they did lose the weekly uptrend overall. Weekly downtrend, tap into the 12 EMA over the course of the day today. I was telling you guys, watch the 12 EMA right around 3150. It might be an area where the bulls play some defense, and they did, but now we're kind of trapped into this awkward range. So you would need to wait for confirmation signals, yeah, for a new daily uptrend for further positions long, or for the lower high with a weak bounce into the rollover. Then you can make an attempt with a stop loss there and target some shorts for possible downside into the 3000 psychological. And now lastly, into our Bitcoin analysis. Well, Bitcoin has been doing a whole lot of nothing over the past few days, and that did not change today. You can argue this is a bull flag at the tops, right? We're waiting for a break of 105 to resume the nice daily uptrend, or a break of 100,000 point, 100.5 roughly to the downside for daily downtrend confirmation and weekly consolidation confirmation. It's looking quite good. It's looking quite good for the bulls. If you are a bull and want to position here into resistance, the stop loss has to go down below here, 100,500. Why? If you break this, it invalidates the daily uptrend and get rejected from resistance officially, and you might just be looking for a higher low at this point, anything above 75,000, looking for that higher low for possible trend continuation. The next short-term intermediary stop is 96K, but not looking too bad in crypto land, as most of the altcoins as well have held up their gains despite being in consolidation mode today. They've ran a ton since the lows. Just a little bit of healthy consolidation. That's everything for your overall market rundown. Now let's move into big tech. Big tech as well, we're going to run through a little bit quickly because nothing has changed. Most of these are still in daily consolidation, pending higher lows. Apple is just the same, getting rejected right now at resistance 222 down to 211. We will see, can they get the job done and continue on this daily uptrend? I don't know, but one of two trades for me is either a breakout retest to give me confirmation, or a slight little back test and gap fill down here. I would gladly write some short puts under the market, as we would be into more of a consolidation phase for Apple. Not too interested in swing trades at the current levels, as the bulls are failing to produce a weekly uptrend officially. That will be a break of resistance, and the fundamentals for Apple right now are a little bit expensive. So it's not the first one on my radar, but all in all, it doesn't look like a bad price action setup right now. Just need to be a bit more patient. On to AMD. AMD down 2.32. We were saying after getting rejected here into resistance of 132 to 119, it may be time for a bit of consolidation after a very nice move. Daily overbought conditions into daily consolidation at this point, anything above 97.12, looking for a daily higher low, maybe back testing the area that they just broke out of, 112 down to 97. If you do pull back a little bit hard into here, I'll gladly write some short puts down below under the market, as we are still in a nice daily uptrend and also in the first stages of finally a beautiful weekly recovery rally right here, weekly uptrend, looking for a weekly higher low at the same time. I'll definitely be a very big fan of writing some short puts if I can under the market, and special shout out to a backtest of the 104, 103 level. If that somehow happens, it might be a nice criteria into these EMAs for some further swing trade longs, as then you get a better risk to reward. Stop goes below there, and then you're targeting into here for a couple of swing trades. Onto Amazon right now, 2.42% to the downside is Amazon, looking for its own daily higher low. After being slightly overbought, bit of consolidation never hurt anybody, as Amazon still is in a very nice daily uptrend. Looking for a higher low right now, anything above 184, higher low for possible further uptrend continuation into resistance, 217 up to 227. These guys from all the way back there. Where am I looking for some swing trade longs? Thanks for asking. Around $200, guys. I'll be looking to write some short puts down there under 200, but also for some short-term longs, it's a very nice entry because then the risk reward gets juicier. Stop goes below here, 184, and your take profit target is all the way up there, roughly a 2-to-1 trade. Not looking too bad, and Amazon's fundamentals are fantastic, as we did cover in their earnings just a few weeks ago. And even here, the valuation is not so bad. On to Google right now. Google down 0.85%. And Google still struggling with its overhead range, resistance range to be exact. 175 down to 162 is the mark for them. Nice engulfing move by the bulls. They're looking to set up a daily higher low and get me a trend change. The other way they can do it is by just blasting above here, give me the breakout, retest. That is a swing trade long entry. Right here, it's a bit of a pain point for taking some longs into resistance, as you don't know whether or not they can reclaim that area. Although momentum does look somewhat good, if we do pull back a little bit more, I'll gladly write some short puts down there, and it might offer better risk to reward. If you pull back a bit more, well, the entries can be down here below 160, stop goes below there, and then you're targeting the weekly leg of expansion, which would send you all the way pretty much into these guys, all the way up here, 177. So it's all about risk to reward, guys, right? Make sure that you're getting paid for your swing trades. Overall, Google, though, not looking too bad. The valuation of the company is still fairly good, and it does appear that as we have set the fear lows and the monthly lows overall into the 2021 highs, I would not be surprised if this company is lifted by the overall market over the course of this year, and if everything remains good, can make its way maybe slowly back into the 180, and then reclaim possibly the 200, at some point within the next 9 months or so. Moving on to Meta right now, down about 2.35%. Not the worst day for Meta, but then again, it was a red day. Everything is consolidating right now in big tech. That is fairly obvious. The higher lows are set right now at 590, just looking for a higher low, possibly for further trend continuation. Now, below us is a very juicy level of support, 600 down to 560. If we come a bit lower into the 12 EMA, then it opens up some better risk to reward, because then your stop loss goes below here for a swing trade long, and the take profit is around $690. Not looking too bad. Fundamentals of Meta are also good. And on the weekly, any extended consolidation, looking for that weekly higher low. This, on a weekly pullback, would be where I would position for some heavier swing trade longs personally, as the weekly MACD is crossing, and the valuation down there at 635 is still very manageable in terms of a forward price to earnings of 25. Pretty low for Meta, and a free cash yield of 3.6, which is quite good. On to Microsoft right now. Microsoft up another 0.04% as it continues creating some lift between us and the most relevant area of support below us, which is still 434 down to 425. Daily uptrend is clear as day, as everybody can see from their earnings, and any move lower will just be looking for a higher low, anything above 430. Higher low, possibly for some trend continuation up here. Keep in mind, though, daily overbought conditions. However, I would love to see this one on a weekly pullback, weekly, looking for a higher low. For further trend continuation, that is a breakout of a high range, and then retest, maybe for some swing trade longs, or maybe a push into the all-time highs. Could be a decent proposition. Microsoft fundamentals need no introduction. It's one of the most solid companies in the market, and I love having it in my long-term portfolio. On to Netflix right now, up about 2.34%. Netflix is so funny, man. Netflix has multiple personalities. On days when tech is rallying, Netflix rallies. On days where growth pulls back, well, then Netflix adopts its defensive stock nature that people have been pooling it into, saying that, well, maybe people won't cancel their Netflix subscriptions into a recession. So Netflix does well, I guess, on every single day, right? That being said, we were looking for a break either direction, to the downside or to the upside, to break this range. Apparently the bulls wanted a bit more. Clear daily uptrend in motion. Any pullback at this point, looking for a higher low, anything above 1,100 for that higher low for further of the swing trade regime. That being said, guys, a bit too rich for me for swing trade positioning at the top end of the range right now, and a little bit too extended from the 12 EMA on the weekly time frame. So no trades from me. In terms of fundamentals, guys, well, Netflix needs no introduction. The fundamentals are very good. We cover them after earnings, record amounts of subscribers and quarterly net profits too. However, keep in mind that right now you are paying a pretty penny for Netflix, so I will not be adding any more to my long-term shares, but very happy that I bought the dip in the correction when it did happen. On to NVIDIA right now. NVIDIA down about 0.38%, also struggling now after its recent daily moves into daily overbought conditions, but it's nice that we are kind of chilling above the resistance range, which is roughly 134 down to roughly 125. That being said, if we do pull back a little bit more, we'll be looking for a back test, right? Beautiful daily uptrend right now. You're looking for a bit of a back test, anything above 115, looking for a daily higher low for possible further trend continuation. Look to the bottom end of this range and the EMAs will be curling up to there. It gives you a much better risk to reward, right? With a stop down below there, and then you're charting an expansion, take profit number one, and then take profit area number two into the all-time highs. NVIDIA looking very good, and I'll remind you they have earnings coming up in a few short weeks, which we will cover on the channel. The weekly close is looking very good if it can close strong like this. Weekly MACD cross does lead us to believe that maybe it just might not pull back. Maybe it has a bit more juice left inside of it. So very good. Any swing trade longs right now did achieve the first profit target into this zone. But if you're holding any more, the next clip out zone, of course, is the all-time highs into the mid 140 range. The valuation right now does definitely support a little bit more expansion, as the company, objectively speaking, is quote unquote cheap, right? Moving on to Tesla right now. Tesla facing a little bit of own consolidation today, but it was a very juicy daily move higher. We were noticing this daily bull flag, and the entries were pretty much swing trade longs here with a stop there at a take profit here. You are almost into the take profit zone. That being said, daily uptrend is clear as day right now with the lift off from here. Any pullback looking for a higher low, anything above this same range, 270, higher low for possible further trend continuation. If we come back too much, that will be a back test of a very juicy level with some EMAs. It's a very, very hotly contested area for Tesla many times in the past, and that would just be a weekly, looking for a weekly higher low, maybe for some further expansion. So any further swing trades on this one, right now you're in the middle, guys. Middle between resistance and support. There's no trades here, realistically, right? It's kind of just greedy longs at this point. Now the weekly MACD is crossing, so any further weekly consolidation could be a nice attempt for more swing trade longs, benefiting from that overall positive momentum. Now, moving on to Palantir. Palantir also down about 1.58%, still above its previous all-time highs, using it as a bit of a shelf right now. The daily uptrend is clear as day for me right now. Daily uptrend, right, looking for a higher low, anything above 105, looking for that higher low, maybe for further continuation. And of course, the next price target for Palantir has to be something psychological like 150. We will see if they can get it done, but the bulls definitely looking good. No swing trade longs for me up here, that's for sure. Just a lack of overall levels and not good risk to reward, right? If my profit target is 150 and my stop loss is down below here at 105, it's an equidistant risk to reward profile. Not the type of trade that I want, but congratulations to all the bulls. Palantir is holding up really well. And then weekly timeframes as well show that they do have a lot of space in the event we need some consolidation, looking for a higher low for further upside. The valuation is not of a concern to many people out there, but it is to me. And even as a Palantir shareholder, it's very high right now. Just keep in mind, I'm not going to say don't buy it. You guys are free to do what you want, right? Just understand you're paying a lot for the future growth of the company. On to SOFI right now. SOFI down about 3.28%. SOFI just the same, right? We're looking for a higher low upon consolidation. That being said, daily uptrend is very nice on SOFI right now. Anything above 1250, looking for a daily higher low. Getting rejected at resistance as we were predicting. 16 down to 14 is going to be challenging for the bulls. It's all those guys from back there, but looking good. They're holding 12 EMA. I would not be surprised if maybe the bulls have a bit more juice left in the tank. Try this one again. That being said, no swing trade longs from me. We're a bit too close right now into resistance. In terms of a weekly pullback, well, we're currently in a very nice weekly uptrend on SOFI. Any pullback will be looking for a higher low, anything above 1040, looking for that higher low, maybe for some trend continuation. I'm a big fan if we do find ourselves back into the low 12s. That is an area where we'll commit more capital for a weekly swing trade long, as the weekly bulls are showing positive signs of momentum. soon to be curling over. So the entry would look something like a 12. The stop would go down below there. Then you'd be targeting the top end here, 16. That is a wider risk reward profile, something that I like a bit more. And for the long-term portfolios, SOFI is still relatively inexpensive in terms of forward valuations, down here in the mid 13s, but obviously it's better in the 12s, right? On to Uber right now. Uber down about 0.28%. Not the worst day for Uber, but then again, just a day of consolidation. They deserve it. They've been pushing so hard in the most recent few weeks. They deserve a little bit of a breather right there. At this point, anything above 80.21, looking for a higher low for possible trend continuation. We'll see what happens. If you unwind into a daily downtrending pattern, I'll remind you what's at stake here. Looking for a higher low on the weekly. And at that point, I'd be targeting this little sweet spot right there, 80 down to 78, juicy breakout retest for a company, maybe for some further swing trade longs. Onto TSM right now as well. TSM down about 0.28% today. Same thing as the rest of semiconductors, right? You're just looking for some daily consolidation. We're now above the resistance range, 193 up to 183. If they close this like this tomorrow, I can close this box green. It will become support. But if we do not have the weekly close, we cannot say who has claimed the level just yet. That being said, any daily weakness could be a nice entry opportunity for either some short puts below the market in the mid 170 range, or maybe some swing trade longs. Overall though, lots of space, anything above 170, as I said, higher low, looking for maybe a second attempt at resistance, or just give me the breakout, clear breakout, and the retest, and I'll take that one too. In terms of the weekly, same concept, guys. Looking for any weakness here. If the daily erodes and goes into a downtrend, you guys know the drill, right? So much space on the weeklies, anything above 146, higher low. Juicier spot is 170 for a back test for a wide weekly trade. When I go through the daily and weekly timeframes, guys, these are smaller swing trades. The bigger ones with more size, I like doing on the weeklies, on the weekly levels, yeah, especially with a weekly crossing MACD and a relatively also inexpensive valuation in light of their future growth and very positive guidance. That's everything I had for your market rundowns. Now, if we pull into a bit of the biggest movers here, Pfizer coming down after the Clover revenue growth during a JP Morgan conference was said to be equal to Q1, and that's not what the market wanted to hear. So that being said, lower round of support, 147. I was not opposed to writing some short puts below the market down here, but you have to give me 140, 130 range. I want to be below this 200-day EMA just so I can use all these guys as support. It's a great company, right? But it's a very competitive space in terms of the fintech landscape. Onto UNH. UNH down again as the formerly civil lawsuit into their billings, or rather investigation and probe by the DOJ rather, has now turned into a criminal episode in terms of fraud allegations. So we went from a civil case in which they were just being investigated and examined in terms of their Medicare Advantage billings. Now they're coming into it with criminal allegations of fraud. So yes, this investigation has been long-standing since last year. However, now they've kind of stepped it up a notch. So that was new information for the markets overall, down 11% on UNH overall. Still not a trade that I'm willing to commit more capital than not to. Not one that I'm willing to put in my long-term portfolio either. It's just a bit of a slow growth company for me, for my long-term portfolio, but it's the highest dividend yield the company's ever had right now. It is coming down into several support ranges, top end 292 to 274, and the bottom end 232. This would be one, if I wanted to build a position, you kind of don't know where it's going to stop, right? Weekly is, everything is massively oversold. Yeah, weekly is oversold, not seen since the great financial crisis. The monthly is also monthly oversold, not close, not seen since the financial crisis, and the daily overall too, right? But as I was saying to my Discord members, sometimes guys, just like Palantir to the upside, a market's price action is a reflection of three things: sentiment, technicals, and fundamentals. The only one that can take over all three is sentiment. Sometimes sentiment is the only thing that matters. The technicals don't matter anymore. It just blasts through all supports as if they're not even there. The fundamentals don't matter even more, even though the company is trading pretty cheap in terms of historical standards right now. All that matters is sentiment. And when it's a sentiment-driven sell-off, sometimes it's very tough to pinpoint the exact bottom. So the best you can do is DCA and accumulate if it's a company that you like. Objectively speaking, it's cheap across everything. The technicals are oversold. The fundamentals are relatively cheap right now, but it is going to be a longer form recovery for this company because it's a sentiment-driven sell-off. Those can turn around quickly, but UNH right now has kind of a lot of black clouds above it right now. I wouldn't be surprised if it's a longer than expected turnaround story. Leap debit spreads will be your best friend because right now for straight calls, the IV is so high, even on leaps. It's like a 55% IV through 2027. Do you want to get IV crushed if ever it consolidates for a long time? No, so start learning about those debit spreads, yeah? Reddit coming down for no real apparent reason. The inverse head and shoulders is still into play. There's a bit of a swing trade opportunity here in my opinion. It's tight though, right? Swing trade is something like this, yeah? Stop goes below the weekly lows because that would invalidate the weekly uptrend attempt. And the take profit area is this resistance range. It's roughly a 3.5 to 4 to 1 with a relatively tight stop loss, going for the expansion of the pattern essentially, and also going for the expansion of a possible weekly uptrend overall, right? After some consolidation and just the risk on sentiment of the market. That's something I was looking at on Reddit. Affirm as well. You guys know me, I'm in Affirm leaps right now. Same kind of pattern as Reddit has, however, it's developed a little bit more quickly. That being said, looking for a daily higher low for further highs. So it might just be a swing trade in the cards for this one. If Affirm is something that you like, and the rest we kind of covered. We're only going to do a few of these, right? I can't do the entire list. And to the upside, just a bunch of other companies. Shout out to the defense companies, guys. There's several trades, not on RTX, but there's several trades. Lockheed Martin is looking like a beautiful long right now. Not financial advice, but I've been writing short puts on it down here when it comes down into there. Swing trade long is not that bad either. The one that I'm in personally is GD. Very nice weekly uptrend formation. Stops go below the low and you're targeting the upside area of resistance up here. So the defense companies with all that renewed trade deal spending could just be the ones to watch. That's everything I had for you guys today in today's video. Hopefully you enjoyed. If you did, drop a like, subscribe, and comment down below if you want anything. That's it for me. Take care and peace.